Gold's going to 3,500 and silver at 50 or something. Silver's down $3, $4 on the week right now or something. Crossovers of the 200-day or the 50-day, meaning they confuse people. Gold has not set structure at the 200-day. You cannot see a flat structure on price. You can see it on momentum. You get back above that 50-day again, and that's about our final signal that this congestion zone, violent up-down congestion zone that we've seen since January 31st, is ending, and we're going up.
BlackRock just said the same thing, 60-40 dead. We're going to go heavy with half of our bond portfolio sold and move into commodities, largely gold.
Either MSA is wrong, and we're actually going to have a massive, not a correction, that's a collapse. You go down to the 50s, which is a uniform chorus, right? Even among gold bulls, got to go to the 50s. And gold's probably going to 3,500. When it goes up, there'll be a point at which, well before you get up to 90 or 100 again on silver, but somewhere in the 70s and 80s, you're going to suddenly explode. The people who doubted it won't have a chance to reposition. Gold's going to 3,500 and silver to 50 or something. Be very careful about that. Huge wave.
There are a lot of people saying that too.
Oh yeah, a lot of people. I'd say the vast majority are saying that, yes.
Turning specifically to gold, Michael, you've noted that gold remains below its key 50-day momentum level. I think you called that pounding on the table level. And it's now, as of yesterday, slipped below its 200-day moving average as well. How significant is that development? Is the market, in your opinion, saying not yet? Or do you see something more concerning beginning to emerge in terms of both of these numbers being violated?
We're aware of a lot of moving averages, and we think they're essentially, most of the time, irrelevant. In other words, crossovers of the 200-day or the 50-day, sometimes they're noise. More often they're noise than not, meaning they confuse people. Gold has not set structure at the 200-day, meaning had gold gone down to the 200-day once a year or two ago, and then another time it held the 200-day, and then the third time you broke through it, that's a structural break. But just to weave through an average that it hasn't seen in eons, is not meaningful. Now, in the case of the 50-day, we're very keen on it because, you're below it, and that's irrelevant too. But the question is what you've developed on structure. When you look at a 50-day average momentum chart, you'll see that once we broke below it a couple months ago, we've come up to it and been knocked down again, come up to it again, knocked down again. You go back a third time and cross that 50-day to the upside.
Markets can spend months convincing investors they missed the move right before repricing begins. As Michael Oliver points out here, repeated rejection at one momentum level matters more than dramatic headlines about crossing another. The overlooked issue is that retail gets trained to fear moving averages, while institutions monitor whether behavior is changing underneath price. If structure forms and breaks upward, capital can rotate fast and late sellers become forced buyers. Next, Michael Oliver reveals why the signal most traders fear may actually mark the exhaustion point of the correction.
It's now structurally important as a positive signal, meaning you have set the structure twice as a ceiling on momentum. You cannot see a flat structure on price. You could see it on momentum. You get back above that 50-day again, and that's about our final signal that this congestion zone, violent up-down congestion zone that we've seen since January 31st, is ending. And we're going up, There have been other rallies within this 5.5 month zone that didn't sustain. You get back above that 50-day again, it's going to sustain. And that 50 days coming down every day because the market's been coming down. So we watch certain averages, but the 200-day crossover, I was aware of that. I think a couple of days ago we broke it. It's not technically important because there's no structure on momentum at the 200-day.
I've heard you talk about something that I've been talking about for a little while too, and that is that the chief investment officer of Morgan Stanley said the 60-40 rule is now dead. Sell half of your bonds, put 20% of your assets in precious metals. The lead analyst of Bank of America, Michael Hartnett, saying the same thing. In fact, he says 25%. Jeffrey Gundlach, the bond king, 25% of your assets in metals is not too much, he says. BlackRock just said the same thing, 60-40 dead. We're going to go heavy with half of our bond portfolio sold and move into commodities, largely gold. My point to you is this, I want to get your opinion. I have an account with Morgan Stanley, and my broker is a good friend of mine.
The institutions publicly defending diversification are quietly rewriting what diversification even means. According to Michael Oliver, the market is not rewarding attention to price alone, but to where momentum repeatedly fails and resets. The bigger contradiction is that major allocators increasingly discuss reducing bond exposure, while the public narrative still promotes traditional portfolio safety. That gap matters because savers positioned for yesterday's cycle rarely see institutional rotation until returns already moved. Next, Michael Oliver exposes the timeline where bond confidence weakened while commodity positioning quietly strengthened.
He's in the Forbes top 40 list. He manages $4 billion. He wouldn't know a gold coin if it fell on his foot. I said, you do know that your chief analyst, the guy that's speaking to the institutionals, just like Michael Hartnett speaking to the institutionals, his newsletter's thousands of dollars a month. I said, are you aware that your chief investment officer said sell half of the bonds? And yeah, in essence, even someone up at that level has no idea what their CIO is saying to the upper strata. Now, I frame it that way because as the price has been coming down, so far in the month of June, 2.9 million ounces of gold have already stood for delivery, with another 289,000 ounces still open interest until the end of the contract, while roughly 1 million ounces have left COMEX, the vaulting system, over the past month, just got up and left. So, all of this money, 2.9 million ounces is over $12 billion worth of metal has stood for delivery this month. 4+ billion have left the system. Yet, despite the apparent physical demand, the paper price keeps getting pushed lower from a momentum perspective. Is this important? Is this divergence important? Is the physical market quietly signaling strength while the paper market continues to project weakness, I guess is what I'm saying. Is that important to your thesis?
That could be, but we don't measure that. But what we do measure is various timescales of momentum measurement. A lot of people look at daily action, weekly action. Well, sometimes we look at that too. Especially in relation to the 50-day average that I mentioned. You get above that on a daily basis, that's technically important.
Markets rarely advertise stress, while inventory quietly disappears behind the scenes. What Michael Oliver is highlighting is that price weakness and physical movement do not always tell the same story at the same time. Billions in metal can shift while paper sentiment remains negative because institutional flows often arrive before public conviction. Investors focusing only on headline price risk, missing where underlying demand may already be repositioning. Next, Michael Oliver unravels why visible weakness and hidden accumulation do not usually peak together.
But the key issue now is that when we look at something like an intermediate metric like 3-month moving average, which is not a long term, but it's, usually when it shifts trend, it'll go for 4, 5, maybe 6 months in one direction. The momentum readings will. Now, what's so funny is when you look at gold on a monthly oscillator, you made your peak in January, okay? 6 months of declining highs. 6 months, okay? You'd say, well, they must have absolutely killed gold. Well, if you go back to the first down month, January, the low in gold was 4,400, okay? It's 6 months later, Jan, Feb, March, in 6 months inclusive. Where are we trading? A couple $100 below there. We've been just above there. And we're still above the March low. Not that it technically matters whether you hold it or not. But the point is, it's been sideways. Silver, same story. It's low in January, February, first drop, $64. Where are we trading right now? So we speak 64.50 or so.
It's the same. It's that sawtooth. It's the
6
volatility.
months momentum down, and yet net price sideways from that first drop. So I would say, okay, if you're bearish, unless you were absolute genius and sold $100 and $120 silver, but more likely you sold it in the 90s or 80s or 70s even, and got out of your position, you've been kissing your sister for 6 months. It's okay. Let's see it. Let's see it then. And we argued in the weekend report. We said that, okay, you better do it now, like this week. You bears better collapse these beasts, Because if you just keep ratcheting little tiny ratchets every day, like silver's down $3, $4 on the week right now or something.
This happened before previous commodity breakouts. Momentum weakened while price refused to break. Michael Oliver's argument suggests time matters more than volatility, because prolonged congestion without real downside often drains the bears first. The overlooked question is why a market supposedly collapsing still holds broad ranges month after month. For wealth preservation, delayed breakdowns can become expensive exits rather than safe ones. Next, Michael Oliver reveals why prolonged sideways action may be the warning sign nobody associates with upside risk.
And all of a sudden you flip back up. It's over. You've had your clock. You've had they just rang the bell. It's the other guy's turn, okay? So now either MSA is wrong and we're actually going to have a massive, not a correction, that's a collapse. You go down to the 50s, which is a uniform chorus right now. Even among gold bulls, you got to go to the 50s. And gold's probably going to 3,500. Well, we'll be wrong if it goes there. But I don't think we're going to.
Well, and to that point, sorry to me to interrupt you there, you also pointed out that every time silver gets pushed back down into this $60 range,
something happens.
There's persistent buyers. And what does that tell you about the underlying characteristics of this market? In other words, who appears to be exerting greater control here? The sellers attempting to force prices lower, or the buyers patiently absorbing this supply beneath the market?
Well, obviously the buyers, when they buy it in the 60s, aren't afraid of the daily price action. Most people are ripping their hair out and screaming. Instead, they're saying, I'll buy some of that. I'll buy it. And they obviously buy it enough to where, you don't stay down there very long in the 60s. You stay down there a week or so. Next thing you know, you're back up. We're arguing that if they can't do it this time, like literally take us into the 50s, like tomorrow, very soon, okay? The clock is old for them, intermediate basis. Monthly momentum is very old. You've not really made any money versus where you were in January. And let's see it then. Okay. And if not, this next rally up is going to be different than the other rallies we've seen.
If this range survives one more aggressive sell-off, portfolios built for lower metal prices may be the ones exposed. This is where Michael Oliver's thesis shifts from prediction to behavior analysis, because persistent buying at lower levels changes who controls the market. Retail often reacts to red candles, while patient capital accumulates where fear peaks. Missing those transitions has historically cost more than enduring volatility. Next, Michael Oliver exposes why repeated support zones can become launch pads instead of warning signs.
Up from under 70 in silver or in the low 400s in gold. This one's going to be different. And I think it's going to be different in that when it goes up, there'll be a point at which, well before you get up to 90 or 100 again on silver, but somewhere in the 70s and 80s, where you're going to suddenly explode up out of this hole in a way that the people who doubted it won't have a chance to reposition. And that's been true. If you look at silver going back a couple of years, there have been plenty of these times where you've had large percent drops, and we've kept cautioning, no, the long-term momentum is not being damaged. And the problem is, if you did get out at those times and felt smart, if you didn't get back in very astutely, you got back in at a higher level, or you missed it. I think that's the condition we're in right now.
Yeah, in your latest report, you suggest that silver may be experiencing its final teaser phase before potentially vertical move higher. You also argue that these declines sometimes are certainly not necessarily the signs of a top, but rather cleansing events that force out weak longs.
Well, certainly done that.
Yeah, certainly have done that. And I think that's a very astute statement, one that I would completely agree with. For investors who see only volatility and fear, what are you seeing beneath the surface in the respect that how do you distinguish between a genuine market top and a violent shakeout occurring within an ongoing bull market?
We turned bearish on gold in 2000 after the 2011 top. We were bullish all during that bull trend that got us up to 1920. Okay. In December of 2011 and January 2012, gold a couple hundred off its high.
The most expensive market moves are usually the ones investors spend months arguing against. As Michael Oliver points out here, violent corrections do not automatically invalidate long-term trends and can instead remove weak positioning. The institutional edge often comes from distinguishing liquidation from structural damage before sentiment turns. Investors waiting for certainty frequently re-enter after repricing already happened. Next, Michael Oliver reveals the historical marker he uses to separate real tops from engineered exhaustion.
When you looked at long-term momentum, like annual momentum of gold, and not the price chart, but momentum, you plotted it, there was like a 7-point uptrend line that was broken. And you broke it literally a couple months off the high. And $100 or so, but $200 off the high. After that break, we turned major bearish and stayed bearish till 2015. When we turned up after the 1,050 price low in December of 2015, we only had to rally gold 2 months up into early February at an $1,140 price, and it broke out over a massive, clearly defined annual momentum floor structure, blew up through the top of the ceiling of that basing action. We have no such clear structure on gold now that is being threatened. In other words, this sharp drop is a sharp drop, but it is in no manner threatening the long-term annual momentum trend of gold. Whereas both at the top in 11 and the bottom in 15, if you looked at the annual momentum chart, you would smack yourself in the face and say, this is bleeding obvious. That's a top. That's a bottom. Right now, we don't have any structural damage to long-term trend. Therefore, we have to treat this as an intermediate trend congestion, violent congestion correction phase, period.
You know, Michael, I've followed you for a long time, and your track record is fantastic. I can remember many walks during the pandemic, living in Minnesota, bundled up, walking this long walk that I had, listening to things you were saying that have been remarkably accurate. And I think you know where I'm going with this one. I can't let you off the hook because you've written that your longer-term target zone for silver remains between 300 and 500.
The market narrative changed, but the deeper trend markers may not have changed with it. According to Michael Oliver, major reversals leave structural evidence long before headlines catch up. The uncomfortable implication is that sharp declines attract attention, while slow trend deterioration does the real damage. Long-term investors who confuse volatility with collapse can end up abandoning positions at the wrong stage of the cycle. Next, Michael Oliver exposes the momentum threshold that historically separated bull markets from breakdowns.
And I've talked a lot about this on my podcast. It's a glimmer of hope for all of us who have held strong fingertips, held on to silver. And you say that it breaks through this level once it breaks free from this prolonged congestion pattern you just mentioned. For those people who believe that such a move sounds impossible, what lessons does market history offer about how quickly prices can reveal or revalue once a market escapes this long-term trading range and enters a true price discovery phase? What I'm getting at is, are you still strongly believing that $300 to $500 range is possible here?
Yeah, well, let's just look back, for example, at the 50-year range silver's been in, between $5 on the bottom side and $50 on the high side, back and forth for 50 years. Okay, and back in early 24, when price of silver was coming up to $25, it had already been at 30 in 2020. But in 24, it came back up to 25 again, approaching the top end of that zone. And we said, okay, you're going to start to gush now. And once it got up to 35, we found some resistance there, not at the $50 level again, at 35. It prevailed for several quarters. And the third attempt to get back up there, 35 one time, 35 another, and then the third attempt, we said this time it's going to take hold and gush. Well, we went up and blew out the all-time highs at that point. And in November, we put out our last long-term buy signal, priced in 56, just barely above the range highs, and said, okay, we're now entering the massive acceleration phase in silver. There will be a correction somewhere in the middle.
Nobody talks about how long ranges end, no? Because the breakout never feels believable in real time. What Michael Oliver is highlighting is that markets can spend decades conditioning disbelief before repricing rapidly. The contradiction is that investors trust long periods of stability more than historical examples showing acceleration phases arrive suddenly. For portfolio defense, missing regime shifts can outweigh surviving corrections. Next, Michael Oliver unravels why price discovery always looks irrational until the move is already underway.
Not necessarily in middle of price or middle of the clock necessarily, but somewhere in this process of going to 3 to 500, you're going to find a correction. It'll probably, scare people. We didn't call the top at 120. It came in literally 1.5 days. You dropped from 120 to 64. Okay, so it was hard to call. But we still assess it as a correction in the middle. But our assessment now is using some historical archives. Copper did the same thing that silver's been doing.
The correction people remember may not be the move that defines the cycle. Michael Oliver's argument suggests historical analogs matter more than emotional reactions to sharp reversals. Fast declines often create the illusion that the thesis failed when history shows acceleration phases can contain brutal resets. Investors protecting wealth should ask whether they are reacting to price or interpreting position changes.